What are mutual funds? Well, mutual funds is a fund that allows you to invest across the markets and diversify your risk without having to individually pick stocks. That is the advantage of mutual funds. It allows you to work across the entire stock market, bond market, fixed income market, commodity market without having to buy individual stocks, individual bonds, individual fixed income or individual commodities. If you have the capacity which does not allow you to spread all your risk, buying mutual funds might make sense, because mutual funds actually diversifies the risk for you. That is one of the biggest advantages of mutual funds. They diversify the risk as soon as you put in money. So if you can't look at buying individual stocks on your own capability, having small amount of capital allows you to get diversified by using a mutual fund. As soon as you make the decision to invest into capital markets, it makes sense for you to consider mutual funds as an investment. If you have small amount of capital at disposal, it might make sense to diversify using mutual funds. So if you are looking at investing into the capital markets, mutual funds might be your way forward. Well, you can usually buy them directly from their fund distributors. You can buy it through an investment-linked insurance policy, or you can buy it using unit trusts. These are the three most common ways of buying mutual funds. If you want to diversify your investment portfolio, mutual funds is one of the fastest ways to get diversification without losing market performance. One of the easiest ways to buy mutual funds is you can go directly to the fund distributors. However, if you want to buy a lot of different mutual funds, you might consider looking at an investment-linked insurance policy or unit-linked insurance policy. And the third way of doing it is you go directly and open up a unit trust account. When you open up a unit trust account, you will be able to access all the mutual funds available in that unit trust account. Well, one of the biggest advantages of a mutual fund is the ability to diversify using money from all the investors in that fund. So diversification is one of the key factors that mutual funds are very good for. The second biggest advantage of mutual funds is there's always easy to liquidate, because there's always a portion of the fund which is held in cash for liquidity. The third biggest advantage of mutual funds are you can invest into markets that you otherwise would not be able to invest money into. So they would actually give you access to smaller markets or more exotic markets that you probably don't have access to. So a mutual fund allows you those flexibilities. You can change from one mutual fund to another mutual fund. That's another advantage. So it's very easy to liquidate from one portfolio, put it into another portfolio, and you always have a value to that fund, which is disclosed usually on a daily, weekly, monthly, biannually or annual basis. So that's all you need to find out. How is the mutual fund priced? Daily, weekly, monthly, biannually or annually. The biggest disadvantage of a mutual fund is the cost structure on that mutual fund. Some of these are not known. So if you have a negative return in the market, your mutual fund, because of their extra cost, makes the loss bigger. If you have a profit in the market, because of the cost of buying that mutual fund, the market return reduces. So the cost associated with that diversification that a mutual fund does. Number two, the mutual fund has a lot of liabilities which they could have. So they could be internally leveraged, which you might not be aware of. So please read the terms and conditions of the mutual fund, because a fund might be taking on liabilities to do the investments for you. So find out what is the methodology of the investment. Number three, you have to monitor the risk yourself. every mutual fund has a risk return reward ratio. You need to identify what's the risks with that mutual fund and what are the potential rewards of that mutual fund. So always weigh the rewards and the risk in the same pan. Don't look at just the returns or just the risk. Look at them in proportion. So you understand what are the risks associated and what are the rewards associated with that mutual fund. And if once you have crossed these disadvantages, you can spend time with a financial advisor or an investment advisor and find out which mutual fund makes sense for you.